And good evening, everyone. Welcome to Saturday Night Live with E Train. I'm Clay. We're glad to be with you tonight. Hope you all have had a beautiful day. And yes, Melissa, we are getting ready for another After Dark stream. So hope you're doing well out there on the West Coast.
Yes.
Ellen is once again uh, broadcasting from one of our remote locations. She's in a new studio tonight, slightly
You
different
noticed.
background.
Yep.
Did notice. I noticed those little things.
You didn't say anything
I just did.
backstage. I mean,
Yeah. Didn't have time for everything, but
yeah.
looks good. Bed's all
Thanks.
made up and everything.
Imagine that.
So glad to have all you finance aficionados back tonight for another episode of Moffat on Money. So hope we've got kind of a different but interesting show for you. We're going to take a journey tonight through one of Wall Street's most controversial, one of its hottest topics, one of its most debated practices, and that is a trading practice known as naked shorting. So we'll look forward to getting into that.
I did look at a few things today, Clay.
Mm-hmm.
Several videos, and they all said something different about what naked shorting was and how it works. So I'm hoping that you're going to teach us like how it actually works and what it actually is. Because I was like, I can't do research if I'm getting a different
Yeah, that's the goal.
definition.
That's the goal. There's a lot of bad information out. Melissa, you're cracking me up. For those of you don't know, Melissa is a longtime member of the family, much loved, much appreciated, and she's in good spirits tonight,
I
as
love
usual.
that.
There's a lot of bad information out, obviously on the internet in general, but tonight's topic, naked shorting, I've seen a lot of discussion on it this past week, and so I thought it was kind of an appropriate time, or would be an apropos topic for tonight.
Hey, Sky.
I am all dressed up. I'm actually wearing a collared shirt. You noticed. See, E-Train didn't notice. See, I noticed the room, but she didn't notice I got, took a bath,
I
showered, and even
noticed
wore a
we didn't
collared
have
shirt.
time. We didn't have time to talk about everything, Clay. Yes, I am in a new room, a new version of the house.
So, Sky, I hope you are doing well.
I love a good mystery. We will keep you guessing. There is no doubt.
And hopefully, while you're guessing, we can, help keep you a little bit better informed. Now, as we get started on the topic, naked shorting, I think I ought to have, or at least in the name of disclosure, I ought to disclose that I have some background in this, having several papers published in academic journals.
Look at you.
One was the namesake for this show, The Naked Truth, which was published in the Journal of Trading. And then this one basically detailed the actual process of naked shorting, which at the time was a pretty much unknown or unpublicized trading technique. There were a lot of people who argued that it didn't exist. For example, Mark Cuban would wax poetic on how naked shorting did not exist, was not a problem. So had several discussions over the internets with him about that. The second paper involves a regulation, one of the regulations that the SEC passed in order to try to deal with naked shorting. And we'll talk about that a little bit more as we go along. So I thought it was just, I guess, incumbent to at least disclose those before
Mhm.
we continue on? Now, in terms of let me say this also about the papers, just a little bit of background on the papers. They have been discussed at major financial uh, conferences, such as FMA, Financial Management Association, where the director of compliance for the SEC discussed it. It's been used in Senate hearings concerning the issue of shorting, and was
Your
also
paper?
used, yeah, was also
Okay.
used by the GAO in auditing the SEC's regulations concerning naked shorting. So these were all part of my dissertation, and the kind of the fun part to me anyway is this. This is after one of my professors told me it was a dumb idea and it didn't happen. So, I still tell my students today, if you want to know if you've got a successful or good idea, just find some professor to tell you that it's a horrible idea and it sucks.
Yep.
So, you know, props to Dr. Ligon if you're still out there. And both of these were accepted for publication, and the SEC started issuing regs limiting it. Of course, after that, he didn't have much to say.
I guess
Well,
not.
let's begin. Let's begin. Start off with short selling, the basics. Because in order to understand naked, you've got to understand regular short selling, the fundamentals. Imagine, for example, you're driving down the road with your significant other, and they like a house that you're passing by. We live on the beach, and so you're driving down, and you see a nice, beautiful house right there on the beach. And, they comment, "Oh, that's beautiful. I love that." And you go, "Well, that's great. Absolutely fabulous. I'll sell it to you. I don't own it, but I'll be glad to sell it to you." Well, they will likely look at you like you're deranged. You can't sell things you don't own, right? Well, in stocks, you actually can. It's called short selling, and it involves, first of all, borrowing a share of stock, then selling it on the open market, just like you own the stock, and you deliver the borrowed security. Well, you owe somebody, you've borrowed that security, you owe somebody that security. So sometime in the future, you have to go out and buy that security and pay off that loan, plus whatever interest accrued in the meantime. So you borrow the stock, you sell it, you repurchase it, return to the lender. Now, you've all heard the adage, buy low and sell high. That is always true. Always, always true. That's the way you make money investing. But keep in mind, there is nothing in that adage that states or implies in which order you have to do it first. If you sell an asset you don't own, then the price drops and you then buy it, repay the loan, you make money. You sold it high, you buy it low.
All right, Clay, you're going to have to break it down a little easier.
Is this an advanced class? Is this the second year? Well, listen, honestly, if I say something that doesn't make sense,
I think
let
she
me
just
know.
did. She just did.
Well, specifically, what doesn't make sense?
I
Like if I
think you started with the short sale, and then you were talking about that didn't make sense.
All right, well, let me try
About
this again.
okay,
Let me go back. A short sale. What is a short sale? Well, let me pause that for a second. What is a regular buying of security? I buy an asset, a stock. I hold on
hmm
to it. The price goes up, I sell it. I bought it low, price. Price went up, I sold it. I sold it high. Buy low, sell high. I can do that in reverse. I can sell a stock at a high price, wait some period of time, the stock drops, and then I go buy it. I still buy it low, sell it high. That is called shorting.
That means if you believe that a stock is going to drop significantly in value, you can buy it betting, basically, correct me if I'm wrong, betting that the value is going to go down.
I wouldn't say betting because it's
Yeah.
not an odds or a probabilistic determination. You believe, just like when you buy a stock, you believe it's going up.
Right.
Well, when you short a stock, you believe it's going down. And you can make money when markets rise, you can make money when markets fall. Either way. And shorting is how you make money when stocks or the market falls. When an asset is overpriced, a lot of people think it's about as high as it's going to get. They can short it. And then if the price falls, they can profit from that. Does that make better sense, Sky? Hope so.
Yeah. Because I think that, if you go ahead and sell it high, shorting it, and you buy it when the price goes down, do you really buy it though, or do you just
Yeah.
is it more like
Well, see, here's this little chart, and I hope this
Mhm.
helps. First of all, you you decide that you want to sell a stock you don't own. So you contact the broker and say, I want to short Tesla. The broker will actually go out and find another account that owns Tesla. And when you open account in the fine print, you agree to lend your stock at the broker's discretion. So the broker's supposed to go find shares of Tesla, and you can then sell those. You've borrowed them, you sell them. So number two, you sell the stock. Somebody out there buys it. Well, time goes by and hopefully the price drops. At that point in time, you buy back the stock. You go out and actually buy the stock, and then you return the stock to the person you borrowed it from, plus whatever interest has accrued. Now, the broker keeps the interest, and which is a little weird. And if you have an account, you'll never know that your stock was borrowed. You're not notified. So there's a lot more to that story that we get in a little bit later in the show. So, but right now, just the basics. You borrow the stock, you sell it, you buy the stock, you repay it.
so you're
Everybody
getting
cool
the
with that?
difference between the low price that you're selling it at, that you're
The
reselling it
high
at.
price. Yeah.
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 The
You
difference
sell it at the
between the two.
high and hopefully buy it at the low.
But then you return it. So
Right. The goal is to profit from the stock's price decline. Again, you want to be able to make money if the stock goes up. You want to be able to make money if the stock goes down. So that's how you make money in declining markets. Now, if you own a stock and the price goes down, you lose money. Likewise, if you short a stock and the price goes up, you lose money because you have to buy it back at a higher price than what you sold it for. And that buying back is a process. You may hear me refer to it as covering the short. So buying it back is known as covering. And in shorting, losses can be substantial, as theoretically, there's no limit on how high the stock price can go. I mean, if you look at Berkshire Hathaway, Warren Buffett's company, this price is $700,000 a share. That's, if you sell it for $100, there's just no cap on how high it can go. So the potential losses are quote unquote unlimited as we refer to it. So it's risky. It's got some risk. Hello,
hey
Carson.
Carson,
Okay, I'm here for at least a little while, but just going to be pretty quiet and chat.
no worries.
Dude, we'd worry about you if you were.
At least he's
Hope you're
here.
doing well.
Yes.
Hope you're doing well. Now, the process of shorting. I see some people argue that shorting ought to be made illegal. And I disagree because shorting is actually important in what we refer to as maintaining a fair price. Sometimes I may refer to it as an equilibrium price. Equilibrium is just where you've got equal numbers of buyers and sellers. So the price is relatively stable. It'll fluctuate, a little bit, but the price is relatively stable at equilibrium, a fair price, where supply equals demand. So those that are bullish on a stock, who believe the stock's going up, as well as those that are bearish, who believe the stock is overpriced, the prices should go down, both need a way to express their views. Now, I use the term bullish and bearish. Some people may not be familiar with those two terms. Um, I guess the earliest written cite we have of the opposing sides, people that believe the stock's going up, people that believe stock's going down, is from Machias Plautus, a Roman playwright in the 2nd century before Christ. He identified two different types of investors engaged in trading shares in his play called Sacurio, The Forgery. Now, he didn't call them bulls and bears, but the first, the bulls, he referred to as mere puffers, like puffing up the stock. The second type, the bears, he referred to as imprudent, talkative, uh, fellows who, without reason, utter calumnies about one another. So people that always talk bad about others. So you have those that believe the good and the great and all is well, and you have those that just see the other side. The term the bull and the bears comes from Great Britain. Sometime in the 1800s, the term bear was coined to describe one who would sell short in a falling market. This arose from the idea of story of a trapper who sold bear's skin prior to capturing and skinning the bear. So he would get commitments to buy the skins, then he would go out and acquire the skins. That's where the term bear came from. We've always had a conflict between the two different sides. And market history is replete with examples. In Amsterdam in the 17th century, there was a conflict between the Liefhebbers, literally the lifter uppers, who were described as being scared of nothing, and then the contrimes, the underminers. And if you speak Dutch, I probably butchered both of those, just going ahead and admitting to that. But the underminers, who were credited with being completely ruled by fear, trepidation, and nervousness. The underminers gained notoriety by organizing themselves into bear pools called Kabbalah in an effort to drive prices down in what was known as a bear raid. Burnham and Schneider, two authors, in a report for 20th Century Funds back in 1935, recounted similar activity in the London Stock Exchange all the way back through the 1700s, which resulted in the British Parliament banning short selling. That ban was in effect for nearly 140 years, repealed somewhere around 1860. So the problem is that bearish investors are constrained to owning 0 shares of a stock when they want to own negative shares. They want to own an anti-share. So the idea as a economist, financial person, is that both perspectives be reflected in the market. The views, their input is important. Otherwise, you only have people who are bullish. You only have the bullish viewpoint represented. And the stock will become overpriced in the euphoria and all the hope and puffery. That's how bubbles occur. And we know where that ends up. A lot of pain when they bust, when the bubble busts or burst. So those who are bearish on the market, they have information, and information has a value and should be freely expressed in the price of the stock. Shorting is risky, but it is a legitimate investment strategy. Give you a good example. Peter Druckenmiller, who, I admire, I think one of the greatest investors in history. In 1992, he and Soros famously shorted the British pound, and they made over $1 billion in one day.
Isn't that how that Soros made all of his money?
Yeah, that's where he got a big start.
Okay.
Or a big boost. The event is known in the currency markets as Black Wednesday, but it shows the power and potential of short selling. All right, so I hope everybody's reasonably comfortable with short selling, the idea of short selling, because you need to be comfortable with that in order to understand naked short selling. So naked. This is the controversial version. This is the one that everybody hates, except those people who are doing it. In this practice, traders will sell shares without first borrowing them. So they don't borrow them. They don't ensure that they can be borrowed. This leads to something that the Securities and Exchange Commission calls fail to deliver, FTD, fail to deliver, where the seller doesn't provide the shares to the buyer within a standard settlement period,
How
which
do you
is
do
3
that?
days, which is 3 days in the US. We're going to look at that.
Okay.
So let me hold off on that question. That's a good question, but
Sorry.
hold off on it for just a few minutes. What I want you to understand is that those failures to deliver FTDs can distort the market by artificially increasing the supply of shares. Now, share price is a function of supply and demand. Everything in a free market is supply and demand. As supply goes up, demand remains constant, price goes down. So if you produce more and more and more of a good, but people don't want any more, price goes down. You've got more supply to get rid of. Price goes down. Well, this shorting of shares, this selling of shares is actually creating artificial shares, what I call a synthetic share, because they don't go out and actually borrow the share. So this ends up driving down the price unfairly. And you think this should be a red flag to regulators. But I'll explain in a minute why it's not.
Hang on. So what you're saying is that you can take a share of a stock and sell it for way less than it's going for, the going rate.
No, I'd still sell it at market price. But it's like there are 100 shares in the market. Company has 100 shares total outstanding.
Okay.
And normally, if I wanted to sell 50 shares, I would have to go out and borrow those shares from somebody. So I would borrow those shares, sell the 50 shares. There's still only 100 shares outstanding.
Right.
Technically, the guy I borrowed them from loses the right to vote and some other things. But the way it works now is that I borrow the 50 and sell them. The person I borrowed them from still has all the rights. The person I sold them to still has all the rights. So there's 150 shares now existing.
But it says short but never borrowed.
Yes. Remember, in shorting, you had to go borrow the shares first and deliver them.
Mm-hmm.
Naked shorting skips that step.
So then you don't ever borrow them.
No.
So then
And
you just said,
you're selling shares to other people. So what you're doing is artificially increasing the number of shares outstanding,
which cuts the price.
which cuts the price.
How can you do that? Sorry.
That's all right.
Everybody's thinking it. You're
It's a
just
fair
keeping
question,
us
but
on the edge of our
we got
seat.
to take this one bit at a time.
Well, you know me.
Yeah. Um, so these shares, I refer to them as synthetic shares. They don't really exist, but they have value because the seller is able to receive money for them. They have value because the buyer invests money in them, but they derive their value from artificially inflating the number of shares. Supply and demand. Over time, as you increase supply, demand remains constant, price is going down. So these synthetic shares are a way of representing the negative shares I talked about previously. Think about it. If I can artificially, without penalty, without restriction, increase the supply of shares while demand remains constant,
Mm-hmm.
that results in a decrease in value. We all agreed on that.
Mm-hmm.
I can actually do it enough by repeatedly selling shares to where I can force the value of the stock to zero. This without having to actually buy or sell one actual share of stock.
Well, you do have to sell them though. You just can't borrow them.
But one actual share. I'm selling
Okay.
these synthetic shares, but I
Right,
never have
right.
to go out and borrow a real share, sell it, deliver it.
That's messed up because it doesn't reflect in the market that the number of shares have increased, correct?
Are you saying it's possibly fraudulent?
You think?
and this is the concern. This is why it's a hot topic, is because it is still occurring. And think about how stock prices move. If you look at the graph here, I've got two lines. Now, one's called a main trend line, one's a channel line. Ignore that. Just call them both channel lines. And you'll see the stock kind of vibrating in price. It goes up to the top line, the cap, and then it drops down to the bottom line, the floor. So, investors own a stock, and the idea is that as the stock price increases, more and more investors start thinking that that stock is overpriced. And so they start selling it. And that ends up being the cap, where enough investors start selling to where the price starts declining instead of continuing to rise. People
But
become more bearish.
it's still gonna decline, even if it's not quote unquote sold by the actual stockholders
Well, this
because
I'm
when
not
they
talking.
sell
Yeah,
it because the price is going down.
yeah, enough people are selling it to where the supply exceeds demand, so that causes the price to drop. So as the price rises, more and more people think it's overpriced. They start selling
Mhm.
it. And then the price drops. Well, as it gets cheaper and cheaper, more and more people start thinking it's undervalued. So they start buying it. So without any news, you have this natural kind of high price, this natural kind of low price that stocks may vibrate in between with no news, just ordinary trading. Well, the thing is, if you look at this chart, once the price starts getting low, more and more people start buying it, and you see the price going up, right?
Yep.
Price is low, price goes up. Price is low, price goes up. Price is low, price goes up. So you see it over and over and over again. Well, with naked shorting, the price, I'm creating more and more shares, and I can create as many as I want. So at this point, when it reaches the bottom of this channel, I can keep selling shares. And so what it ends up doing is breaking through this channel. And the people who think it's cheap, their orders are filled with these synthetic shares. And I can keep selling more and more. Does
That's
that
messed
make
up.
sense?
Yeah, but it's messed up. Carson.
So I'm wondering if the topic of shorting was inspired by recent events in big pharma. There quite possibly is some going on. Better known examples would be AMC, GameStop, Tesla.
Tesla.
Pardon?
I said Tesla.
Tesla.
Mm-hmm.
Big pharma has declined since the election, but I think a good bit of that is due to the incoming administration's stance on some of the intimacy between the FDA and big pharma. Some of that's going away, and there's going to be some of the immunity is going to be removed. So,
As it should be.
yeah, I would say there's probably a really good chance that some of those shares are now being naked shorted, but I can't prove that right now. But what I want people understanding, what I want you to understand is that instead of bouncing off this bottom channel line, if I can keep supplying shares with no limit, I don't have to borrow the stock. I can just create these synthetic shares, these negative shares, and keep supplying everybody that thinks the stock is too cheap at no cost to myself, and keep driving the price lower and lower and lower.
That's crazy. So why are they allowed to do this?
I'm going to ask you to hold that question for a few more
Damn it,
minutes.
Clay. You're killing me.
Pain is good. Extreme pain
Oh,
is
man.
extremely good.
I want my questions answered. I want them answered now.
Here's an example. A company that I actually did a little research on, more than a decade ago, called Global Links.
Yes.
Global Links, I don't know. I hope you can see this line. They were
Yes.
somewhere around $40 a share back in 2008. And then, as you can tell, the price got absolutely hammered until it went near zero. The company ended up going out of business. And it went to court and it subpoenaed all of the major brokers. And just out of the major brokers and an FOI request to the SEC, determined there were 27 million failed to delivers outstanding in company shares. And keep in mind, this is at a time when Global Links only had authorized shares of a little bit over 1 million.
So this was a naked short.
This was naked shorting, which
and the
created
shares
26 million synthetic shares. How do you destroy the bid? You keep pumping free shares into it. They only issued 1.1 million shares, but there were, and this is only in the major brokers and the ones that have been disclosed to the SEC, 27 million shares in those broker accounts.
That's
There were a
crazy.
lot of brokers that didn't report,
Hmm.
and we'll look at why later. So 27 million is the minimum. It could easily be double that.
But they only had 1 million.
Only had 1 million that they had issued and sold. But the brokerages had 27 million shares on their books.
Okay. I know you're going to tell me. I'll answer it in a minute. Is this more a broker problem or a company problem? Because the
I'm going to
brokers,
go.
damn
I'm
it,
going to go with
Clay.
broker.
Okay, because they're creating the shares
They're involved.
essentially, huh?
They're involved. We're going to look at that. But I need everybody kind of on the same footing, understanding the basic terms, the basic idea, and then we can get more into the details. Um, so basically, if I naked short without borrowing, I sell shares, an unlimited number of shares. I can keep printing them and meet every investor surge. The group thinking is that as the price continues to drop and the price continues to drop, even though I was buying, you think maybe I'm wrong. And so I'll start selling shares. And so everybody, fear takes over and everybody starts dumping the company. The price just hits the floor. It eliminates naked short selling, eliminates any positive price response by bullish investors.
Okay,
And the
I got another one. You're probably
okay,
going to answer it. Is this due to like something against the excuse me, against the company? Like, are the brokers like, we don't like this company, or politicians or something, go and take them down, end them?
it's nothing personal. No,
Okay, well,
nothing
Carson,
personal about it.
it was just shitty. I'm sorry, but shitty.
They're just the target, and we'll look at some reasons why some companies are targeted. Um,
Carson.
Carson, we've got 150% like rate right now. I hope that's a good thing. Let's
I
keep it
think
up.
so. Yeah.
So, as a naked shorter, one thing to keep in mind, the naked shorter is just continuing to sell shares, and people are paying him for these synthetic shares. So, all they're doing is adding to his profit because he never has to go out and buy the shares, or he can wait till the price is super low. The the main goal when it's really extensively shorted is generally to drive the company into bankruptcy, like Global Links. A lot of companies will have their loans to private investors, equity investors, or whatever, collateralized by their stock. And as the stock price gets hammered and drops, the investors start calling their loans. And that forces the company into bankruptcy. Well, if a company that you're short goes into bankruptcy, you never have to buy the shares because the shares are worthless. So you've got 100% profit on everything you sold.
That's just evil. I'm sorry.
Well, it gets a little bit better in the smaller markets known as the OTC BB, the bulletin boards, and the pink sheets. These are called sometimes penny stocks. There's no protection. The SEC doesn't care. The SEC won't enforce anything.
uh,
Carson, caught up in hot drunk speed.
Carson listens to it at like 2 times speed until he gets to normal. Then when we are normal, we sound like we're shit faced because.
and yeah, talking too slow, slurring, whatever.
Mm-hmm. Mm-hmm.
So, selling into this crash just adds to the naked shorter's profit. I can sell as a naked shorter, I can sell all the shares that the suckers will buy. There's no protection in the smaller markets, in the off markets. To qualify for the regulation exemptions, market like Global Links started out on NASDAQ, but once your price drops significantly, you get delisted and moved to these smaller boards. So it's kind of a subtle effect. You do enough shorting, whatever, to get the price down to where the company's delisted, then you can hammer it. The
I feel like
SEC just doesn't
I
care.
feel, I feel like we're teaching people how to commit a crime to make money.
Well, as an individual, you really can't do this.
Okay.
So, we are explaining how, quote unquote, a crime is committed. So, as a result, naked shorting is done pretty often, at more extensive levels in penny stocks. Normally, there'll be some sort of pump and dump. The microcap stock is forced to trade at or near the minimum price of 0.001. That's 1/10,000th of a dollar.
And this is
Or,
how the Wolf of Wall Street made his money. The pump and dump penny
yes,
stocks.
yep. So they make money they buy the shares, they pump it, the price goes up, they sell their shares, and then they start naked shorting it. And they make the money on the downside. So they hit you coming, they hit you going. Cool little gig if you can get it. Get them to make a movie about you and everything. And we know many of these small caps use their stock as collateral. So it ends up forcing many of them into bankruptcy. So the shorters never have to worry about closing out the shares. No need to buy the shares. Profit is 100% of the sales price. The regulators don't or can't really stop this. So it's a risk-free profit. It's free money to the people doing it. Add that to the movie night list.
I got it.
We might need to do that again, actually.
I think we do.
And, Wolf of Wall Street would be a good one. Trading Places, The Big
Big Short.
Short. All of those would be good. And the beautiful thing about this is, particularly in the smaller markets, this is legal. It's all legal because the NASD rule, traditionally the NASD rule 3370, which was superseded by FINA 1186 and some others. But market makers are allowed to legally naked short in markets characterized by a plethora of buy orders at a time when there are few sell orders. So market makers are the ones who handle the transaction. They take people's orders to buy, they take people's orders to sell, and they'll either match buyers and sellers or they sell out of their inventory. Market makers will buy stock, put it on their shelves, they'll sell stock out of their inventory. Market makers. So if there's a bunch of people wanting to buy, but not many wanting to sell the pump, they can synthetically sell the shares. And as they keep selling more and more, the price, may rise a little bit, but then it kind of peaks and it starts to drop. I'm not even going to say that one. How about just drunk Carson in the naked chat?
Moffat, I am
Yes, ma'am.
sending you an email, and you need to look at it as soon as you can.
Okay, well, that's interesting.
Yeah.
While we're pausing here, anybody have any questions on anything I've covered so far? I hope this is.
Yeah, I want all of my questions answered.
Yeah, I hope this is starting to make this is making sense to you.
Yeah, apparently someone that we all know responded to one of Clay's posts. Did you see it?
No. I mean, I'm looking at your mail, but I'm not sure what I'm seeing.
There is a name on it.
Yeah, that's me responding to Elon.
I heard, no, he responded to you.
Oh, I didn't see that. Um, well, if he did, good. He's following the right people.
Yes, he is.
Um, and I hate saying I don't know why I'm saying it. All right. So let me get back. This is legal. Naked short selling is legal at certain occasions when a market maker is faced with more buy orders and insufficient sell orders. They are allowed to naked short the stock in order to meet the demand and maintain a quote unquote stable price. Regulations. Usually if something is majorly screwed up in the universe, in the economy, in the country, it probably oftentimes is associated with regulations and unintended consequences. So theoretically, a market maker can legally sit on the 0.0001 cent level and sell these non-existent, these synthetic shares all day long, because at no bid and 1/10,000th of a dollar ask, there is a huge disparity between buy orders and sell orders. Well, there are numerous examples of this, such as global links. Now, I mentioned regulations. How pervasive is naked short selling? Well, several papers in 2004 and 2005, Bonifiles Finnerty, indicated that on average, 700 stocks. Now, this is in the major markets, S&P, Dow. On the average, 700 stocks had failures to deliver. When I say failures to deliver, you can pretty much imagine or substitute naked short. Had failures to deliver of 60 to 120 million shares each that had persisted for 2 months or more. In addition, in the unlisted stocks, remember I talked about the smaller markets like the bulletin board and the pink sheets. In those markets, there were an average of 800 stocks listed with fails of 120 to 180 million shares, 2 months or longer. So the total is you had 1,500 stocks with failed to delivers, representing 180 to 300 million shares a day. And this was back in 2004, 2005. It's hard to get current data today for reasons you can estimate. Now, in one SEC paper talking about this phenomenon, the SEC estimated the value of these shares was $6 billion. Again, back in 2006 or 7, if I remember. $6 billion. But keep in mind, that's the depreciated value. The equilibrium price of these shares could be 5 times, 10 times, 20 times, 50 times that amount. 6 billion includes the value with all the synthetic shares. Take those out and you've got who knows what kind of value. Now, finally, in 2008, the SEC started issuing regs, several measures to try to limit naked shorting. Some people say, and I saw it, several current comments that the SEC outlawed naked shorting in 2008 with regulation SHO. It did not. It did not outlaw naked shorting. SHO, regulation SHO, which is the topic of my second paper, was an effort to try to curtail it, not make it completely illegal. Because remember, the market maker exemption, there are times when the market makers, calls and puts. A call on a stock is a right to buy that stock at some time in the future at a contractual price. Apple right now is trading, I don't know, let's say $200. Well, I can pay $5 and have the right to buy Apple at $200 3 months from now. So 3 months from now, Apple's at $250. I can still buy it at $200 with this call. So I pay $5, I buy it at $200, I turn around, sell it immediately for $250. I make $45 per share. That's a call. A put's just the opposite. I can sell it at the contractual price sometime in the future. Well, market makers who sell puts need to hedge that position because they'll have to pay it out if somebody decides to exercise that put against them in the future. So they have this market maker exemption where they can naked short sell securities without going out and borrowing them in order to issue puts, in order to help hedges. It is my belief that hedge funds have taken advantage of that exemption and worked with market makers and brokers to kind of abuse that privilege and use naked shorting to hammer some of these stocks.
Hey Clay, we've got a comment on X, and it didn't show up on here for some reason. It's supposed to. It's Jim says naked shorting adds zero value to society. This illegal tactic only benefits the criminal counterfeiters.
By and large, I would say yes, and I think that's why most reasonable people don't like it. In looking at the market maker exemption, I do understand the intent. And I've thought about this some. The market maker exemption allows market makers to offer hedges to people who are, concerned about a position. If I'm a portfolio manager and I've got a $10 billion portfolio and I'm concerned about the market going down, I may want to buy puts on my stocks or the S&P 500 to hedge my downside risk because I can't sell $10 billion worth of stock. I just, you can't. A lot of mutual funds require that the managers remain 95% invested in the market. So they can't reduce their ownership below 95%. But they can buy puts to try to reduce their downside risk. So market maker exemption allows this kind of hedging. But there's also the argument to be made that naked short selling, the loss in value that accrues to current shareholders from this action, the current shareholders are paying or subsidizing the hedging. Does that make sense? Because the more synthetic shares that are created via naked shorting, the lower their value would be otherwise in most any scenario. So they are, in a de facto way, subsidizing the hedging, lowering the cost to hedge positions. And the more I think about that, the more I think that's not right either. So, I'm kind of moving toward the position that naked short selling should be eliminated completely, which is easier said than done for reasons we'll still get to. But it's a good question. It's a fair question. And I believe, it's reasonably accurate. So I hope that answered your question. If you have a follow-up or if it didn't answer it, then ask another question. Ellen follows the question, so as soon as she gets back, she'll relay it to me. Now, regulation SHO. Regulators implemented several measures. SHO is just one of them. Well, in the SEC's own words, naked short selling is tantamount to counterfeiting securities. That's the SEC's own phrase, counterfeiting securities. And they have, cited examples where the failed to delivers exceed the entire float. The float is the number of shares that the company has in the market. Like Global Link's $27 million shares versus a 1.1 million share float. So regulation SHO enacted some borrowing and delivery requirements on short sellers. I don't know what all to say on SHO, but this pretty much sums it up. It did not ban short selling, as I've already mentioned. The SEC introduced the bill to address concerns about persistent failures, not short-term failures, but persistent failures, those longer than 5 days. And, it was an effort to try to limit what the SEC refers to as abusive naked short selling. So it requires brokers to have reasonable grounds, quote unquote, reasonable grounds to believe that the security can be borrowed. And that's a big phrase. The security can be borrowed before affecting a short sale, a naked short sale. And it imposes some requirements to close out the sale when there's an extended fail to deliver. The naked short seller should be required to close it out after a period. Every trading day, at the close of trading day, it produces a list of stocks who meet those requirements listed in SHO with excessive fails, stocks that have been extensively naked shorted. Now, it doesn't give us the number of fails or the total amount, total value. Doesn't really give any information. It's kind of worthless in that regard. But it gives us a list, and it's for listed shares only. So stocks in the major exchanges, the smaller markets, are not included. The micro caps are still fair game for naked shorting. So if shorters can get a stock price low enough, get it delisted, they can hammer it to oblivion. The SEC doesn't care once the price falls enough, which is kind of weird. Melissa, I was hoping I wouldn't have to derail naked chat on my own. We wouldn't want that. So most people who have watched the show know that I'm not a fan of regulations. And SHO obviously is one of those the paper that I wrote on it, and this was, only, a year after it had been implemented, found that there was strong significance, or that it was highly, highly, highly likely that if you saw a stock listed on that SHO list as having an excessive fail to deliver position, that if you went ahead and continued to short it or implemented a new short, that you would continue to earn above average returns. So in effect, this regulation, SHO, just pointed out targets for other shorters to take advantage of. Regulation SHO was a complete and utter failure. And that's one reason why the paper was discussed in various environments. Now, in late 2008, when the market was crashing, the SEC tightened rules again. It included a rule called 10B21, known as the naked short anti-fraud rule. The more rules they pass, the less effective they get. And if you look at, modern regulations, the modern results, kind of Cliff Notes version here, the SEC just charged an investment advisor last year, Savvy Management, and its managing partner with fraud relating to naked short selling. So it is still an ongoing issue. Despite all the regulations, the reform of regulations, the revisions to regulations, it continues pretty much unabated. Again, I say unabated. That's my opinion. The SEC doesn't give good access to data. And in preparing the show, I wasn't able to file a Freedom of Information Act request, take 9 months to get a result from them, and then have to refile it. But what we do know, traders, despite whatever regulations are in place, traders find a way to circumvent the rules. So the more complex the regulations, the easier it is to bypass or to make the transaction opaque. I was reading today that the IRS code is about 70,000 pages. How the hell do you know how to fill out a tax return accurately? You have no way. Same with the SEC. Thousands and thousands of pages of regulations. I mean, Bernie Madoff ran his Ponzi scheme for 20 years. And the rules were so confusing that it's hard to know what's right, what's not right. Now, so how do traders bypass these regulations? Well, we're going to look at a couple different ways. One, Carson, what we do know, crash, is that a prediction? Maybe. One form that is relatively common that I think is used often, from what I can tell, is called a 0+ agreement. 0+ agreement. Now, that's a form of financial engineering used by traders to try to obscure their trades. The intent behind the trades, particularly as applies to naked short selling. So how does this work? They have agreements that structure trades in such a way that they appear balanced or net neutral on the surface, hence the term 0+. Let me back up for just a second. When you buy a stock, you don't actually own the stock. You buy a right to all the benefits that accrue from ownership of that stock, but you don't actually own it. It's held in trust, and the trust actually owns it. Let me back up to the 1950s, 1960s. World War II's over, troops come home, everybody's working, has money, prosperity is just taking off, so people start investing more. Well, back then, there was physical certificates, physical stock certificates. And the way that it would work, if you wanted to sell a stock, you took your stock certificate to your broker, you signed it in front of him. He did a thing called a signature guarantee. Then he calls you've seen these little mad bicyclers that zip in and out of New York City traffic. Hands it to one of those. They take it down to the transfer agent, a bank like Citibank or Chase or whatever. Citi takes this certificate. You have 1,000 share certificate. You want to sell 500. So there's a note attached, and it's taken to the transfer agent, who takes that certificate, stamps it canceled, and prints 2 new certificates, each worth 500 shares. Gives it to the bicyclist, takes it back to the broker. The broker gives you 1 certificate for 500, sells the 500 shares to another broker across town. So you sign the 500 share certificate. He guarantees it, gives it to the bicyclist, who takes it to the broker across town who bought the shares for a client. Client comes in, signs the certificate, given to the bicyclist, takes it to the transfer agent. Transfer agent cancels that certificate, issues a new 500 share certificate for the buyer, takes it back to the broker, delivers it to the client. A bit of a tedious, paperwork intensive, cumbersome process. So as demand for stocks and stock transactions started soaring in the early 60s, the stock market literally had to shut down for 1 day or 2 days a week just to catch up on paperwork. So there was no trading. All the brokers knew that this couldn't continue, so they got together and they came up with an idea. It's called street name registration, to where they all created a trust. They all own a share in the trust. And this trust actually owns and handles the accounting for the certificates. All they do is report at the end of the day the transactions. So you don't have to go sign certificates. You don't have to sign affidavits. Your signature doesn't have to be witnessed. And the broker, at the end of the day, sends to this trust called the DTCC the number of shares that you either bought or sold during the day. And the DTC records that number. Sometimes the broker, you may sell 500 shares. Well, the broker has a client that wants to buy the 500 shares. So it just does that in-house. It doesn't report any net change in shares to the DTCC, the trust, because there is no net change. Now, if shares are transferred between brokers, those are recorded by the DTCC. But in brokerage, intra-broker trades are not reported. Only the broker knows. The broker handles all the accounting. So, Ellen, that's kind of an answer to one of your questions earlier.
Got
In
it.
terms of, how is this not illegal? Because the regulators can't see it happening, because it happens
Sadly.
within the broker. And the broker doesn't report any net change of shares. Okay, zero plus agreements, back to zero plus. So when we talk about, them concealing the true intent in the naked short selling, the brokers kind of help with this. So what happens is the trader enters into several transactions. The first one, naked short selling, dumping shares. The second transaction is where the trader agrees to buy an equivalent amount of shares. So he's selling 1 million shares, he's buying 1 million shares. Net, that's zero. So the broker doesn't record any net change in the shares. But the buying, and this is the creative part, the buying is done through a related entity or at a future date using a forward, for example. A forward, and this is what I've got kind of the image here. If you want to understand a forward, think of it like this. Farmers actually created forwards. Because, a wheat farmer, his wheat is harvested in August. along with every other wheat farmers. And so the supply of wheat peaks in August, September, supply and demand. With the supply up so much, that's when prices are lowest. Well, the bread makers, everybody is buying their wheat, storing it. There's some winter wheat harvest, et cetera, et cetera. But the highest price is when wheat is the most scarce, January, February. So farmers are like, I wish I could capture this this higher price. I wish I could sell my wheat in January instead of August. And that's where forward comes from. A forward is simply an agreement to do a trade in the future, some point in the future, at a price agreed upon today. And that price is today's market price. So, wheat in August may be $3 a bushel. In January, it may be $6 a bushel. So the farmer may sell a portion of his wheat in January using these forward contracts. And that's what you see here. He enters a forward contract, agrees on the price, and he delivers that crop in the future. You can do that with stocks as well. You can enter in a forward agreement to sell the stock in the future at this price. So they enter into an agreement with a company, a shell company or another trader within the same broker. And so net, they've got 0 shares. So nothing is passed on to the DTCC. Another, thing for them to do is use like an equity swap. And an equity swap is where you're trading the return on stocks for an interest rate. Again, there's some shadow bookkeeping and shell companies, so it ends up being kind of a farce transaction. But they can create these artificial sales to go along with the naked shorting. Does that make sense? So these instruments allow for a delayed settlement, months down the road, a year down the road. Allows for future payment while maintaining the appearance of fulfilling the buy side of the transaction. Another transaction they can do is like a repo agreement, a repurchase agreement. The buy side is structured to repurchase to buy back shares. You lend shares as collateral, and then you buy them back sometimes in the future. So repos can also be used to maintain the appearance of compliance while keeping their trading position essentially unchanged. There's some bookkeeping entries that are made, but the actual monetary transaction is nil. The value is that they keeps allowing them to naked short shares. So these types of instruments are chosen because they give the appearance of legitimate market transactions, but they allow the manipulator to maintain complete control, avoid any capital risk, and delay actual financial outflows. He just has the income from the naked shorts coming in. Now, why 0 plus?
Fungibility. Sorry.
Yep. It allows the trader to create the appearance of a neutral position. It's a way to circumvent regulations. Regulation SHO, for example, requires brokers to locate or ensure that shares can be borrowed. Don't have to borrow them, just can be borrowed before executing the short sale. 0 plus agreements, meet that requirement, or I should say probably bypass this requirement by obscuring the nature of the transactions. It
I would
allows
agree
the
because they never borrow the shares.
never borrow the shares. It allows the market to be manipulated. The short seller can, flood the market with shares, even if they don't physically exist, and depress the stock price, just like we talked about earlier. It's the negative shares. That's most effective against smaller and thinly traded stocks. The price manipulation is easier. It's in the small off markets. The SEC just doesn't care. And it's difficult for regulators, even if there is some change in the uh, number of shares reported. Another complication to outlawing this activity is that shares are fungible. The way they're reported to the DTCC, what the regulators see is total number of shares. The shares aren't associated or tied to any specific account or any specific transaction. There's only a net number reported. So if
But
E-Train owns shares, I own shares, the broker knows that. But the DTCC, the SEC doesn't.
so the broker knows that, let's say 100 shares, you own 50, I own 50, but then there's a whole bunch more being sold and they don't pick up on it.
Well, one, it can all be netted out in the broker.
Okay.
Two, if it's between brokers, one broker may report 50 shares sold, another 50 shares bought. So, but the SEC doesn't know who's buying or selling or what the origin of the trades were or what
Gotcha.
underlies that net difference because
That,
just the gross shares are reported.
that seems to be a flaw in the system.
It definitely is, but the way it's constructed, and it would not be easy to change. That's how it is. It's like you can convert $10 into two fives. Those are fungible. They have the same value. It's hard to identify one $5 bill from any other, or the purchasing power of two $5 bills versus a $10 bill. It's
So essentially,
fungible. That's what we mean by fungible.
so when I was growing up, I was taught that you learn the rules of whatever it is, the company you're working for, the game you're playing, the whatever, and you do what you want to do within those rules. Is that kind of what's going on here with the brokers?
Restate that question for me.
Okay. If you learn the rules of the game, the laws, the rules, okay? So these brokers know the rules, but they're getting away with it because they're playing or they are doing business in a correct and quote unquote proper way according to the rules and laws they have in front of them. But they're just
Right.
bypassing a loophole, so to speak.
They know that they're manipulating the rules. And that's the advantage of regulations for lawbreakers is the more detailed the regulations, as long as they adhere to that specific detail,
Right.
what they're doing is legal.
Even though
Now,
it's really screwed up.
I've often said that if I was king,
If
in terms
I
of
were king of the forest. Sorry.
yeah, in terms of the regulation necessary for the SEC to enforce, it'd be real simple. Number one, pay for what you buy, deliver what you sell,
Mhm.
disclose everything. And number four, if you don't understand what any of that means, stay out of the market. Oh,
Sounds fair.
probably one more. No lying, cheating, or stealing. So the problem is with detailed regulations, they don't just say you can't lie, you can't cheat, you can't steal. Those words have to be precisely defined. And so if there's a precise definition, then there's a way to get around it. All right, what's Carson up to now? I'd rough
He
and
and
I'd
I rough.
rough.
He stopped the song. He was continuing on.
Oh, thank you, Carson.
I appreciate that, Carson.
Let's see, Clay, you pronounced that name wrong. It said like Madoff, which seems like it was a clue. Maybe a little clue.
Bernie Madoff with your money.
So 0 plus. I'm being a little bit Cliff Notesy, but I could really bore you with some of the details, but I hope this makes sense. Again, if you've got some questions, don't hesitate to ask. Another way in which brokerage firms are able to receive compensation, let's call it from market makers, for participating in this is called payment for order flow. Payment for order flow. And honestly, I saw this flow chart and I thought, that is the worst looking flow chart I think I've ever seen. The
It's a
least
confusing.
the least descriptive flow chart I've ever seen. I don't know who put it together, but I thought, that's just kind of appropriate for tonight. I'm going to pass on that one too.
Y'all, this chat does get a little off kilter at times, but it's all good. We love each other. No problem.
Yes, we do.
That's kind of
Part of the
funny though.
family.
That's right.
And we appreciate y'all, watching in and joining the family for tonight.
Yeah, all of you on
We really,
X. Hi. Good to see you.
those on Rumble, appreciate you all joining in. If you got any questions, just type it out. Ellen will forward it.
That's why I'm looking in like 10 different directions and trying to keep up with everything. So,
All right, payment for order flow. Now, again, this is kind of an intra-broker deal, not between brokers. So, a broker is it's like Schwab, Merrill Lynch, the large brokerage operations. They will have market makers working in their realm, handling the trades, buying the securities, selling the securities, kind of setting the price. So understand the difference. The brokerage firms, the market makers are two different players, usually. A broker can be a market maker as well. Now, the brokerage firms actually are paid by the market makers. They receive a rebate or other third parties in exchange for routing their clients' orders to them. Like Tesla, it may have 40 different market makers making a market in that stock. Well, Schwab may have an agreement with, a few specific ones to route orders to them. And in exchange, those market makers take part of the spread that they make, the commission they make, and give it back to the broker. It's called payment for order flow. And this arrangement is common in the financial industry. So you place an order to buy or sell through your brokerage. The brokerage doesn't actually execute it, they route it to a market maker. So the market maker then executes the trades. It maybe provides a little improvement on the price than what other market makers are doing, but not necessarily. In exchange, the broker receives a fee for routing the order. Okay, payment for order flow. The market maker profits from the spread. If you look at a quote for a stock or a bond, you'll see a bid and an ask price. The bid is what the market maker pays you for your stock. The ask is what you buy the stock. So the ask is higher than the bid. if you just bought a stock and then immediately turned around and sell it, and the market didn't move, you would lose a little bit of money. That little difference is called the spread, and it's where the market makers, it's the profit that the market makers receive. Well, they share that with the broker. And that's still the worst chart I've ever seen.
Mm-hmm.
I just,
I wouldn't have even put
I,
that up there. I mean, that's just so confusing.
yeah, it just absolutely communicates nothing but chaos. I don't know who put it together, but they were drunk at the time.
Obviously.
Uh, Now, this payment for order flow, it's a significant source of revenue for brokerages, particularly those offering commission free trades. You wonder how a broker can stay in business offering commission free trades. Well, it's because of the payment for order flow. They are being paid in the background. And some of them, like Robinhood, rely very heavily on this payment for order flow. With regards to naked shorting, payment for order flow can be used to obscure the origin of orders and their compliance. The way this works is largely through what's known as off exchange venues or dark pools. So the broker will route a trade to a dark pool. The dark pool doesn't report the transaction. If you're watching the stock market, you'll see the ticker with all the stocks and their trades, the number of shares, and the price at which it was executed. For the first, I don't know, 75, 90 years, whatever it was, all trades had to be disclosed. And the ticker was the way that the trades were disclosed, the price and the number of shares transacted. It didn't give you any information on who was buying or who was selling, but it gave you the price and the number of shares. Well, I don't know, 20, 25 years ago, dark pools started up. They were normally pre-market and post-market, and the dark pools did not report their trades to the ticker or to the exchanges. And this is a way that large volume trades, like a mutual fund wants to sell 1 million share block. Well, they could do it in the dark pool, not have it reported, but they could also negotiate the price a little bit better. So dark pools kind of took off for the big trades and the larger institutional investors. Well, obviously business has been good for them, and now they exist, and brokers can route orders to market makers in the dark pools. There's less stringent reporting and oversight in the dark pools. By less stringent, I mean zero. This makes it easier for traders engaged in naked short selling to avoid detection. These are called dark pools originally because of no reporting. Well, they've become even darker because now that's where investors are defrauded. No disclosure, no tickers, no discovery, no revelation, nothing. I don't know why the SEC allows it. But again, vote for me for king, and it won't, that would end quickly. An
I mean,
example of some of,
shouldn't that be something that they can handle in the government and be like, okay, you can't just bankrupt companies because it's fun.
well, they have come out with thousands of pages of regulations. And the more complex it gets, the more opaque everything gets. The more
Exactly. I mean,
complicated things get, it's harder for people to understand and follow what's going on. It's easier to conceal.
yeah, true.
So, you know, I think there just comes a time when you have to start over, burn everything down, start over, shuck it down to the cob, and
Yep.
say, you know, pay for what you buy, deliver what you sell. That immediately would end naked short selling.
So why aren't we doing
Um,
that?
because a,
Because you're
a
not
lot
king.
of Yeah, because I'm not king. The industry has remember the volume of shares and the fail to delivers I mentioned earlier from 2004, 2005, 180
Mhm.
million shares a day. There's a lot of money being made doing this. Now, some of the fails to deliver are accidental. Paperwork is lost. Somebody, when they're typing in something, hits the wrong key, but that's a very, very small percentage. And also the SEC, the regulators. You go to work as an attorney with the SEC, you work there 5 years, then you go get a job with one of these large investment firms making 3 or 5 times the money.
Right.
So, are you really going to risk pissing off one of these major investment firms you hope to work with in another few years and, quadruple your income? Probably not. You'll probably be a little bit less interested in it.
True.
So there's a lot of people that have a vested interest, a huge financial interest in this trade. Um, look at 1921. We've seen the date on GameStop. GameStop at the time had short sellers with 140% of GameStop's outstanding shares. So they had not only shorted every share in existence, they had shorted an additional 40%.
That's just
And
crazy.
most of this, the vast majority of this, was done through dark pools. The dark pools mask the large short positions, the failure to deliver rates, whole thing. And we still don't have good data on the details. And that's a big problem. In 2021, Gary Gensler, the chairman of the SEC, the head regulator in the country, expressed concerns about this payment for order flow process, he suggested in 21 that it creates a structural conflict of interest and undermines market transparency.
Yeah.
Well, did he do
That's
anything about it?
no. At
Didn't do
least
a
he was right
damn
about it.
thing about it. So anyway, payment for order flow, it does enable commission-free trading, but you know, if you use Schwab, the commission is you could buy 1,000,000 shares for $9, $8. Do we really need that to be commission free? For, the real small investors, I can see some advantage, but realistically, I would rather have, more straight up pricing and eliminate the under the table deals.
Right.
So those are a couple ways that naked short selling is masked from the regulators. And keep in mind, in the fail to delivers, when I talk about the number of fail to delivers, that's only the inter broker trades between brokers, the number of failed to delivers between brokers that are reported to the DTCC. The intra broker trades are not reported. The FTD's intra broker are not reported. The fails to deliver in the off markets, the bulletin board, the pink sheets, the gray sheets, is not reported. So what we know is just like an iceberg. We just see the tip of the iceberg. We don't know and can't get full good data on what's actually going on and the extent of it.
And you may have mentioned this. I was working on some trying to get X and everything synced, but what is the consequence for fail to deliver?
Well, it depends. If you have a market maker exemption, nothing. You are in many cases it's legal for you to do it. And that's the big problem. In the dark pool, we have no idea. We don't even know the numbers, failed to delivers. If you're in an exchange and you are a small investor and the broker entered into a short sale between it and another broker,
Mm-hmm.
They then have to locate the securities and deliver the securities. But
but they don't exist.
that's a small percentage of the actual fail to delivers.
But they don't exist. So how do you create them out of thin air?
I'm saying that, like, if I'm with, I don't know, Schwab,
Mm-hmm.
and I short shares and somebody at Merrill Lynch buys them,
Mm-hmm.
and the broker for some reason didn't find the shares, didn't locate the shares before I sold them, but still let me sell them. Well, then that
Mm-hmm.
broker is responsible to find those shares and deliver them after the fail to deliver. But that's just a small percentage. It was an oversight, it was a typo, some problem.
Okay.
If the broker is allowing the market maker to naked short sale securities within the broker,
Mm-hmm.
there is no fail to deliver reported. It's an inter-broker problem, and the
So
broker is being
technically,
paid
nobody
and the
got
broker
hurt.
is being paid by this market maker for
Right.
this additional volume of trades. So that's the conflict of interest. Does that make sense?
Yeah, because so
So
nobody in the brokerage got hurt. So there's
so
nothing
far,
to,
right.
yeah.
Yeah. So the brokers are complicit with the market makers, kind of turning a blind eye, going wink, wink,
Nod, nod.
to
Yeah.
the naked shorting that occurs intra broker or in
Got
the
it.
dark pools.
Fair enough.
Now, so, I've tried to convey some sense of the difficulty in regulating this because the current
Mm-hmm.
system, just even the SEC, has to subpoena and get the broker records and then, tear through all those. It has to have a basis for the subpoena. So detecting naked short selling is challenging due to the complexity of the financial transactions involved, due to the settlement process, due to the complexity of how securities are traded and settled. So there's we just don't have good information on the extent of it or even when it occurs. So regulatory bodies, the SEC, they say they monitor and try to address violations. And
Mm-hmm.
for example, in last year, 2023, I think I alluded to the fact that the SEC charged Sabby Management, Sabby,
Mm-hmm.
with fraud. Um, and here is the press release. They were charged with basically naked short selling, but the technical charge was manipulation of stock prices and spoofing. Spoofing is when, now we live in an age of computers. Everybody knows that. And computer trading, algorithmic trading has gotten to be huge. It's the vast majority of all trades now. But computers are so fast. Sometimes they will just throw up a price for a millisecond. You'll never see it, but other computers see it and will react. They'll buy, they'll change their pricing, whatever. And so you've got all these computers throwing up these spoofed prices just for millisecond or 2 milliseconds in order to try to determine reaction from other computers. So it becomes kind of a gamemanship competition between computers over who can trick who into losing money. Well, if the computers do it automatically, it's not illegal. But apparently the
See,
SEC, yes, ma'am.
that that's just wrong too. Sorry.
you know, I could go on about this for a while.
I know.
But the SEC charged Sabby with throwing up some of these fake prices and not honoring the price, spoofing. It's basically fraud. And it was related to what the SEC charged was naked short selling activities. Now, Sabby argued in trying to get the case dismissed, and I'm not an attorney. I'm not trying to render legal advice here. Maybe we can get LawTube folks to join us one night and cover some of this. But SABI argued basically that it had rights that allowed it to obtain the stock through convertible securities or warrants. Convertible security would be like a bond. You own a bond, and sometime in the future, probably 5 years from its issue, the bond can be exchanged for stock. So I buy a bond in a little small unknown company, but it's
Mhm.
convertible. And in 5 years, I can trade that stock for 20 shares of IBM. And so in 5 years, if IBM is worth $50 or $100, I can trade that stock for 50 of those shares and make money. So there are some bonds out there that are convertible into stock. A warrant is when a company is issuing shares, new shares. It's already got shares trading in the market, but it's going to issue additional shares, sell more shares. And so it will give existing investors a warrant or the right to buy additional shares. And these warrants can be traded, can be sold. And so SABI was saying, hey, we've got the right to buy the shares. Remember, in short selling, you're supposed to locate and borrow the shares and deliver them. Well, with the market maker exemption, they were arguing that all they had to do was locate the shares. And with this convertible right and the warrant rights, they quote unquote located the shares. Does that make sense?
Mhm.
You with me? Okay.
I am. I'm
That
still trying to work on X, so I do
no problem.
apologize.
No problem. You're just kind of my little feedback if I'm making sense.
Well, y'all, feedback to Clay while I try to fix the X thing.
Well, SABI also argued that it wasn't responsible for its clients' actions. And this is the interesting part. The judge disagreed. The judge in the case stated that brokers are gatekeepers and may be primarily liable, her words, primarily liable for manipulative trading by their customers. Now, I thought that was a hell of a statement. And if you if you hate naked shorting, which I'm thinking most people do by now, that probably is a good thing. I'm a little hesitant. I'm kind of a big free market guy, and making a firm liable for what its clients do or customers do, I think is dangerous ground. Like GM, is it liable if somebody gets drunk and, hits somebody else in one of their cars? But to me, the big difference is GM wasn't informed. GM wasn't part of the drinking. Whereas the broker is fully aware or should be fully aware that shares are being sold without being located because it's ultimately the broker's responsibility to locate the shares. So from what I can tell, that's a pretty interesting opinion. If it holds, if SABI is found liable due to that standard, that would take a hammer to naked short selling. I mean, it would have to go through the appeal process, would have to be held up, but brokers would be taking a look at that potential liability due to their, I guess, not conspiracy. What's the word I'm looking for? Due to their cooperation in participation in receiving profits and funds, payment for order flow from naked short selling and people who actively naked short sell. So the case continues. It is still being adjudicated. There's been no final ruling in it yet, but that will be something to keep an eye on. So ultimately, naked short selling. It poses significant challenges, obviously, to investors who own shares. To me, it really poses a challenge to market integrity. The whole idea of small investors trading is they believe they can get a fair shake. They believe they have to believe that they have equal access to information and that the market won't be gamed against them. Otherwise, they won't be investing in the market. While admittedly some regulations have evolved to try to curb the practice, all it has is transformed, in my opinion, transformed it into a more complex and sophisticated deal. It hasn't really limited its practice. So, that's kind of the sum, the whole of naked shorting. Anybody have any questions? Does that make sense? And if you're interested, see if I can get this up. If you're interested, come on, computer. If you're interested in reading more,
what if they want to read your publication
about the judge's opinion, here's this article.
Okay.
Yeah, I'll put it up in just a second. The case is Harrington Global Opportunity versus Civic World Markets et al. Judge Schofield found broker-dealers may be primarily liable for manipulative trading instituted by their customers because they serve as gatekeepers. All right, for those who are interested possibly in reading the two articles that I put up, the efficacy of regulation SHO or the naked truth. No, because they are copyrighted. The journal actually owns the rights to them.
Okay.
But what you can do is you can Google the titles.
You can't put a link to those on X?
I can put a link to the journal, but for most journals, you need a subscription.
Okay.
But I think there are copies floating around, let's say. And I can't tell you, I can't tell you to go look at those. That would be me advocating that somebody, violate copyright. But I just wanted to warn people that there are non-approved copies floating around.
So if I put them on my X,
you would probably be violating copyright law.
Why?
Because
I did it personally.
When you publish an article, you sign a little piece of paper that gives the journal the right to that article. That's why they publish it.
But I didn't.
It's kind of like a record. If you make a song and produce a record, the record company actually owns the rights to that song and receives the royalties from it their own.
We will put all of the information on X, Moffat on Money.
Yeah. I will list the titles, and you can Google them from there and probably come up with the information you're looking for.
Fair enough.
Okay.
Goofy.
Also, if you haven't followed us on on Twitter, X, Moffat on Money, please give us a follow. YouTube.
Like the video. Subscribe.
Like the video. Hit the subscribe.
If you have recommendations for what we should cover next or what you want us to cover next, please let us know.
And if you've got questions, even if it's after the show, email me moffatonmoney@gmail.com or DM me on Twitter. We'll be glad to discuss them. Tuesday nights, we have Tuesday night Q&A, which is really a time for you to ask questions. And we have all sorts of rambling dialogue and discourse there.
And Clay also has a Manette channel, which is also in our descriptions on both YouTube, X, and Rumble. Right? Here we go.
I thought you had another question or something.
No, just putting everything out there for anybody who wants to contact you, us, whatever.
Now,
that is X, that is Gmail, and Manette.
Yeah, just a few other things going on in the world. Been an interesting week in the market. Dow, the Nasdaq, the S&P 500 are all going to close the week in the red. Nasdaq was down about 2.8%, its largest weekly decline in several months. The S&P has dropped probably, I want to say 2%.
Really?
Yeah, it's been an interesting week after the rally. And we've talked about, Druckenmiller and Buffett raising, cash positions. So there's some reasons to be cautious. Some people are talking about, a severely overbought technical position. In terms of the S&P 500, I'm not necessarily a huge technical trader, but there are a lot of people that, follow it somewhat closely. So if some of the technical indicators start getting overbought, it kind of becomes a self-fulfilling prophecy sometimes. Technology sector has been having a rough time lately, and that's the one thing that has been driving, the Mag 7 has been driving the returns in the S&P 500. We've talked about the Magnificent 7 versus the other 493. Well, the Mag 7 is not looking so magnificent. A lot of people think without, large cap tech continuing to lead the way that the market rally can't continue. And they have been lagging lately. Right now, for the S&P 500, the top 10 companies comprise about 35 to 40% of the whole index. So that's 10 out of 500 companies are nearly 35 to 40% of the index. That's huge. That's about as high as it's ever been. That may be a red flag. Obviously, there's a lot of chaos, with the Fed's changing decreasing, I'll get it right in a second, cutting the interest rates. I know. It's hard to think and talk at the same time.
It is.
All the underlying signs seem to indicate that inflation and maybe, is increasing slightly, but increasing. And the Fed's still cutting rates. Why? A lot of people go, is the Fed stupid? I don't agree with the Fed on a lot of things, but I wouldn't call them stupid. Jay Powell is rather aware of what's going on. I think, they see some things that are underlying that haven't gotten a lot of attention or publicity. And we've talked about some of those things on this show. Some of the weakness in, underlying the economy and in the industries, particularly in the private sector. The only growth really has been in the government sector, government and healthcare, which who funds most of healthcare? Government. Yeah. So the private sector has been getting hammered. Also, stocks, like I say, if you look at forward PEs and all, they are high. Some of Some of the indicators are that, it's significantly overbought. So if inflation continues to increase, another big thing that I think Powell's aware of is the unrealized losses in banks, particularly the regionals and the smaller banks. 2 years ago in March, the Fed started a program, lending program to banks. Remember, SVB and First Republic failed. Well, the Fed, initiated an emergency liquidity program, BTFP, to lend banks who were having liquidity issues, money that was necessary to keep them afloat so there wouldn't be more failures. Well, that money is coming due in March. And actually this last month, out of the 65 billion remaining that hasn't been repaid, somewhere around 30 billion was paid this past month. So there's only 25, 30 billion still outstanding.
Okay.
That's a lot of money taken out of the economy paid to the Fed. Also, the Fed's liquidity programs like the reverse repo program has gone from 2.7 trillion down to 200 billion. That's a lot of liquidity taken out of the economy.
Yeah, it is.
So there's a lot of cash that that has left the economy. Liquidity is getting more and more constrained. So you've got a lot of parts moving, and none of them really point to a robust future. So a lot of people are thinking, particularly as the new administration takes office, that there's going to be some pretty heavy economic consequences to all of this. Not exactly a perfect storm, but not far off of it. Not only that, but the new administration promises a lot of new things that will impact the economy. Depending on who you listen to, depends on how the impact is projected. But, increasing tariffs, cutting or even eliminating income taxes altogether, deporting illegal immigrants. Each one of these has consequences and impacts of its own. Some of them short term, maybe negative, some of them longer term, more positive or not. Like deporting illegals. First, they're going to go after the drug dealers, the sex traffickers, the criminals, gang members, etc. So you would think that would lead to it.
Who were all receiving benefits.
Yes. So you would think that would lead to one, decrease in violence. Two, you would have less money being drained out of the federal coffers. Most people don't know, but a lot of these people are receiving Social Security benefits, full Social Security benefits. Once they request asylum, they're entitled to receive, Social Security benefits, SNAP benefits, Medicaid. So you would see a reduction in federal spending. If Elon and Ramaswamy are able to cut spending, get that through some, that would have effects. Layoffs in terms of the government bureaucracy. Now, Elon is saying there won't be immediate layoffs. What they'll do is they'll have a rather long separation payment, maybe a year, maybe 2 years worth of salary. So you won't have people immediately hitting the markets who have no money. It'll give them time to transition into the private sector, out of the government sector. So you won't see immediate cuts in government spending per se. But how does all this sort out? I mean, we've talked about this, some of these, a little bit in our shows. We'll talk about it more in the future going forward.
Melissa.
But there's a lot going on. Melissa, who will pick all of our produce? That's a fair question. I remember in the 80s, I was doing a lot of investing out in the San Joaquin and the Coachella Valleys out in California. The San Joaquin Valley is probably about the size of the state of Alabama. It's not a small little region. but it produces, I don't know, 30, 40% of the nation's fruits, vegetables. And we had, for example, an asparagus farm was one of the initial investments. And I don't know if you're familiar with harvesting asparagus, but it's back-breaking work. You're literally humped over a plant with a knife, cutting the stems and putting them in a bag all day long, up one road, down the other. And in what was it, 85? I think I think it was around 85. I don't remember the exact year, but the government passed a law stating that you had to have um, a green card or a work permit or a valid US birth certificate in order to
Well,
be employed by American companies.
didn't they make the is it HB2 visas just to come work?
Yeah, those exist, but you had to have official documentation to be employed by an American company. So we
Oh,
said, okay, we'll comply. We had been paying the migrants. I don't remember exactly. I think it was $5 or $7 an hour. And we thought, okay, we'll offer $18 an hour for American workers. And this was back in 85. $18 an hour was pretty good money. And the first day we had 100 people show up. All of them, valid and everything. So put them to work, hired all of them, put them to work. The second day, only two showed up. The third
hard work.
day, neither one of those showed up. So we had choices. We had this, huge crop that, still needed to be picked and picked soon. We could either let it rot on the vine or we could hire the migrants. So we, like a lot of other San Joaquin Valley farms, hired the migrants. And it's an interesting phenomenon. San Joaquin Valley is so large that the harvest season starts on the southern end and it literally matures over the next month or 2 months going north, the crops ready for harvest. And so the migrants literally start in the southern end and then just move north to continue harvesting all the different crops. So Melissa's point is, who will pick that?
Mhm.
Well, my understanding of the
Hang on,
implementation of this,
hang on. Before you answer, it is none. And if I didn't have to tinkle, I wouldn't say I was leaving. But I figure by the time I get back, you're probably done. So I just want to say good night to everybody and thank everybody for being here. Mwah. Good night, Clay. I'll talk to you soon and I'll see you guys on Tuesday. Cool?
good night.
We good? Good night.
Enjoy it. Thank you.
Thanks.
So, real quick, my understanding is that it's going to go in phases. One, get rid of all the criminals, violent offenders, gang members, drug traffickers, sex traffickers, those folks. That'll be the first primary issue. That's a fair chunk of people right there. Tracking them down and hauling them out, making sure they don't return. The second will be and I have no idea of the numbers, but there's a lot who are in the country who are not working. We've seen the stories of the immigrants being put up in 4 and 5-star hotels, like in Manhattan and downtown New York City, who aren't working, who receive all the benefits, all the money that we just alluded to, Social Security payments, a visa with $10,000 prepaid on it, et cetera, et cetera. That'll be the second group. So the unemployed, who are basically just kind of mooching off of taxpayers. And then that leaves those that have jobs, which my understanding is that won't necessarily be heavy pressure. The pressure will be for them to register, to get work visas, to start paying taxes, that kind of thing, to get them registered. Some who may be deported, don't know the final details, but that's a legitimate question. That's a legitimate issue, is who will pick the crops? And increasingly automation is going to be handling the work But there are some crops, asparagus, some of the others, that you still have to do by hand. So that's a good question. Can't give you an absolutely complete answer, but that's my understanding so far is that it will be done hopefully in a reasonable manner. Any other questions? As Ellen said, it is 9 o'clock. We normally try to keep it to, a couple hours. Um, so if anybody has, any questions or comments that you think of even after the show, we'd love to hear from you. We uh, hope to see you Tuesday night where you can bring all your questions on most any topic. Like I say, Tuesday night's oftentimes kind of rambling. Don't really necessarily prepare anything. We just kind of have fun with the family. And so would love for you to join us, during that time. We're here every Saturday night at 7. Um, Give us a follow on X, on YouTube. Hit the like button, if you will. Do really appreciate y'all being here with us tonight. Hope you enjoyed it. Hope you got something, a profit from it. And we'll look forward to seeing you again. Y'all have a good weekend, good week ahead. Blessings to you all. Our time is up. We thank you for yours. Good night, everyone.